All right. So as discussed, we are going to be looking at the only outstanding scope we have under risk and uncertainty will be decision tree. And not only that, that reminds me, because this is financial management at case level. So last week we didn't talk much on in fact we did not discuss risk adjusted method and certainty equivalent method. So once we are done with decision tree, I will go back to that so that you have the understanding, because at this level it's possible for examiner to test such method of hedging risk and uncertainty. Therefore, it's only important that we also discuss it at this level. All right. Uh, okay. So quickly, let's talk about decision tree. Now, what do you understand by decision tree? Decision tree is just a graphical representation of various courses of action involving complex investing and business decision. Okay, involving complex and then complex business or investing decision. When you use decision tree, when the scenario, when the situation, when the various courses of action are kind of complex. Okay, so it's not something that is more straightforward, like we have seen under expected value method, under standard deviation, sensitivity analysis, or simulation. When it's a kind of decision tree is used to analyze a course of action when you have multiple kind of scenarios. Say, for example, you may want to decide, okay, you may want to decide if uh, under various courses of action, under various states of nature. Say, for example, you have good or you have high, medium, and low demand, and you want to know, okay, if the customer's reaction to the company's product is high, there's a probability of, say, for example, 40% that the customer will purchase so much, all right? There's a probability of, say, 30% that customer will purchase average, you have high, medium, then low. So when you have that kind of a thing, and then the examiner is also telling you that, okay, if the market's response is high, okay, there is a probability that, so when you have different kinds of multiple scenarios, and then it's not kind of a straightforward, then in that case, you cannot use other methods to analyze the scenario. It has to be decision tree. So generally in an organization or among companies, decisions are made in relation to business extension, okay? In relation to business extension, merger and acquisition, make or buy, or contraction of the business, whether expansion or contraction of business. So this kind of a course of action will require, okay, will require a meticulous way of organizing or considering each courses of action. So in this situation, you will need the decision tree, which will allow for a systematic means of evaluating the courses of action. Okay, so like I said, the decision tree should be used anytime you have multiple variable or multiple scenarios. All right, when you have whereby in a situation whereby you want to make a final decision, but before you make the final decision, you must make a sub decision. All right, so in such scenario, you will need decision tree to analyze the situation. Therefore, anytime you want to evaluate a project using decision tree, all right, there are some specific procedures we are supposed to carry out. However, before we talk about the procedures, there are two key nodes, okay? There are two key nodes that you are going to need anytime you want to construct a tree diagram. We have what we call decision node. The decision node is the node whereby you are going to make the final decision. Everything starts when you are constructing your tree diagram. Everything will start from the decision node. You walk forward. Then to make the final decision, you come back to the decision node. Then the second node is the chance node. This chance node is where you are going to represent the state of nature in the economy. You can have good, bad, worse in the economy. You can have boom and recession. You can have high, medium, low. You can have above average, then below. You can have most likely, okay, you can have pessimistic, most likely, or more, whatever. So the state of nature will surely be given to you the question. So when you are going to use this chance node, okay, to represent the state of nature with the associated probability. Okay, so those are the two nodes that you are going to need anytime you want to construct your tree diagram. Therefore, there are about five procedures that you are supposed to carry out anytime you want to evaluate a project using decision tree. The first procedure is to construct a payoff table. Okay, the first procedure is to construct a payoff matrix table. So in this payoff matrix table, you are going to have horizontal line. You also have vertical line. When we get there, I will explain to you in details, especially, okay, don't let me digress. All right, so the first step is to construct a payoff table. All right, this payoff table, you can even ignore it, okay? You can ignore it if possible. I will show you when we begin calculation. Then the next one, after you have constructed the payoff table, then you need to draw a tree diagram, okay? You draw a tree diagram. Now, when you want to draw a tree diagram, like I said, you are going to start from the decision node. All right, anytime you want to draw your tree diagram, you start from the left side. Okay, the arrow that will follow your decision node will depend on the decision that you want. It will depend on the alternative courses of action. Let's say, for example, if you have three courses of action, and among the three you want to select one. So in this case, you are going to draw three different arrows. All right, so option A, option B, then option C. Any of the options that has the highest possible outcome or that has the highest payoff is the one that will come into the decision node. That's where you are going to make your final decision. Okay, so of course, when you are constructing your tree diagram, you start from the decision node, like I said, then you walk forward. Then to now make the final decision, you now walk backwards to the decision node. All right, so out of the three alternative or two alternative, or if it's only one, whatever it is, here is where you are going to make the final decision. Okay, so that is as per the tree diagram. When you are constructing your tree diagram, you are using the payoff table. You are using the information in the payoff table to construct your tree diagram. All right. Then step number three, of course, when you are constructing your tree diagram, you are expected to assign probability of occurrence to each state of nature. Okay, the probability will surely be given to you in the question. So you need to attach it, or you need to assign it to each state of nature. All right. So at times probability may not be given to you, but you are going to be given, in that instance, you are going to be given the state of nature. So it is that state of nature with the associated value that you may use to determine your probability. But in most cases, probability will be given to you, especially at this level. All right. Then step 4. Not only that, apart from attaching probability to each state of nature, you also need to assign monetary value, okay? For each of the nodes that you have constructed, you need to attach value to them. You need to attach monetary value. Then after that, then you label the nodes. So when you are drawing your tree diagram, like I said, you are starting from the decision node, all right? You're starting from the decision node. After the decision node, you construct your event node. Immediately after decision node, what will follow should be the event node. So depending on the state of nature, so you walk forward. You walk forward. All right? You walk forward. At the end of the day, let's say, for example, you then close your tree diagram here. Let's say you close it here. For example, this is not like a network analysis, so it's not network. You know, let's say, for example, this one stop here, whatever. You now begin to, you have to label each of them. Let's say this one is A, this is B, this is C, D, E, F, G, then H. So you are going to label each node alphabetically or numerically, whichever one that is more convenient for you. What is important is that you just have to label your nodes, all right? Then after that, you then determine the expected value. You determine the expected value for each node, all right? Because here you are going to attach probability of occurrence, then with the monetary value of each of them. So you use that one to determine the expected value. So you then use the expected value to determine your final decision. But however, if in the question you are given cost of capital, it means that you have to discount your cash flow. You have to discount your cash flow to the present value equivalent. But at the end of the day, you then make the final decision whether the project should be undertaken or not, or which of the alternatives that the company should select. So that's basically what you need to do as far as decision tree is concerned. However, so let's have illustration. Let's have illustration to demonstrate this. So we are going to solve just one question. Just solve one question and then we'll be done with that. I don't know. Of course, I know some of you are not doing performance management. Under performance management, I will solve another question whereby you don't have discount, you don't have a cost of capital. But in this one that is FM, majorly, if examiner is going to test you on that day, it will be the one that involve cost of capital. All right. In any case, let's have illustration to demonstrate this. Okay. Let's solve this illustration number 8. I would have this is the same thing as illustration number 7, but this one does not have a cost of capital. I would have loved to solve that one too, but again, for majority of you that are doing performance management, it's still the same question, so it will become monotonous. If I solve it here, I'll go there again, I will solve it. So it become monotonous. However, I will see what I can do. Maybe if I solve it under PM, then I will share with you in FM so that you have the idea. All right. But in any case, because I know some of you are not doing PM, so let's solve this one that involve cost of capital. All right. So let's solve illustration number 8. Tintin PLC. Yes, Zoom user. You have not read anything since day 1, and earlier today you distracted my class. You are making noise at the background. So Zoom user, you are the one that will read the question. Read for us. Oh, have you disappeared? Okay, no worries. I will catch you again.
No, Zoom
Yes.
user is Ada.
Ada, oh, okay. You change it to okay
Sorry.
then. All right. Read for us, Ada.
Oh, okay. My voice is not so loud.
Tintin.
Okay. Good evening. All right. Tintin PLC is considering a project involving the outlay of 300,000 naira, which it estimates will generate cash flows over its 2-year life at the probability shown in the following table. cash flows for the project. Year one, do I have to list them?
No. Yeah,
Okay.
you can just go through it.
Okay. Year one, cash flow, 100,000. The probability for should I just skip it? Okay,
Then
cash
year
flow
two.
100. Yeah, 100,000. Then year two, if cash flow in year one is
If cash
if
flow in
cash
year
flow
one
in
is
year one is
100,000,
yeah, there is a probability of that the cash
0.25.
exactly. So should I read
That
it
cash flow
out?
in year two will be nil. Yeah.
Mm-hmm.
Yeah. So leave the table. I will express it when I'm solving it. Yeah. Next one.
All right. Note, all cash flows should be treated as being received at the end of the year. The company's investment criterion for this step of project is 10% required. A, what is the expected value of the project's MPV? B, what is the probability that the MPV will be negative?
Yeah. So in the A, thank you, Ada. In the A
Thank you.
part of the question, examiner is asking you to calculate expected value of the project's MPV. You know, whenever you want to compute expected value, what are you supposed to do? You will multiply probability with the cash flow. You then use the expected value to compute NPV. The same thing the examiner is asking you in this scenario. However, in this question, we cannot use expected value method to calculate NPV. It has to be decision tree. Why? Because the cash flow in year one is very direct, very straightforward. You are given the cash flow with a probability of occurrence. Just multiply 100,000 by 0.25, you get the expected cash flow for year one. But year two is different. Look at year two cash flow. You are told that if cash flow in year one is, that is, if cash flow in year one is 100,000, there is a probability of 0.25 that cash flow in year two will be nil. All right. Again, if cash flow in year one is 100,000, that's a probability of 0.5 that cash flow in year two will be 100,000. So this is what I'm talking about. You can see in this year two cash flow, it's not straightforward. Year two cash flow is dependent on year one cash flow. So when you have this kind of a scenario, you cannot use expected value method, the ordinary expected value method to calculate your NPV. It has to be decision tree. All right, it has to be decision tree. Therefore, you need to represent all of this information in a tree diagram, for you to be able to do justice to the question. Okay. All right, so we want to compute expected NPV. We want to compute expected NPV using this scenario. The first thing we are going to do is to construct a tree diagram. After we are done with the construction of the tree diagram, of course, we labeled the node. We assign probability of occurrence and monetary value. Then we determine the expected monetary value. Then, of course, we compute our NPV for each of the nodes. All right, so without wasting more time, let me stop sharing this and move to the working notes. Okay, so this is solution to illustration number 8. That's page 73. Page 73. So first thing first, like I said, on the day of your exam, when you see this kind of a question, you have to be very careful. When you are constructing a tree diagram, please pay attention. Don't start from the main page of your answer booklet. You need to go and do a rough sketch at the back of your answer booklet. Don't do a rough sketch on your question paper because invigilator may think that you are writing expo to one of your to your friend in the exam hall. So don't write anything on your question paper. Write it on the on the answer booklet. You just go and do a kind of a rough sketch at the back of your answer booklet. Then once you are satisfied with your drawing, then you can move it to the main page of your to your solution page. All right. And then again, when you are constructing your tree diagram, please don't use pen. You have to use pencil, right? Use pencil because certainly you are going to make mistake. You cannot have a perfect drawing at the first instance. You are going to make mistake. You are going to commit error. Therefore, and because if you are using pencil, you can easily erase the mistake. But if you use pen, you can't clean it. That means that page is wasted. You have to cancel that page and move to the next one. How many errors are you going to commit? And that's why it is important for you to use pencil. Even the fact that you are using pencil, you have to do a rough sketch of your drawing. Once you are satisfied with it, then you now move it to the main page. That's that. Then in addition, when you are constructing a tree diagram, please make it very bold because some of you some of you that are mindset, you like to manage your notes. For example, for those of you that are attending physical class, or maybe you are writing as you're having online, then you have a note that you normally jot from. So that you divide one page into four. Don't go and do that on the day of your exam. You have to make it very bold. You make your tree diagram very bold. If possible, you can even make it a landscape. All right. If you can't make it a landscape, but just make it very bold and make it legible. Therefore, let's construct the tree diagram together. So remember what I said. Anytime you want to construct a tree diagram, you are starting from the decision node because you are going to use decision node and the chance node to construct your tree diagram. So we are starting from the decision node. I will then come here. You start from the left, you walk to the right. Okay. Now, the next arrow that will follow my decision node. Don't go and be writing decision node or chance node. No, you don't need all of that. Just draw it. All right. So the next arrow that will follow my decision node will depend on the courses of action. How many courses of action do we have in this question? Only one, because examiner told you that Tintin PLC is considering a project involving the outlay of 300,000. It's only one project, but when you have more than one project, that means you are going to draw two arrows. But in this case, it's only one. Therefore, I will just come here, one arrow. Then in year zero, this will be in year zero. At that year zero, we are told that there is initial outlay of 300,000 naira. So I would then say initial outlay 300,000. Okay. Now, immediately after the decision node, the next thing that should follow will be your chance node or your event node. This chance node will depend on the state of nature given to you. So in this question, like I said, state of nature, probability is usually attached to state of nature. In the state of nature, which is the events in the economy, you can have good, bad, worse, high, medium, low, okay, boom or recession or steady state in the economy. Whatever the state of nature, probability is usually attached to it. So in this question, that means we are given three different probability. It means that we have three states of nature. Okay, so in that case, I have to divide this one. I have to divide my event node into three. So there will be 1, 2. I hope this will be sufficient for me. Then 3. Just watch the way we are going to be constructing the tree diagram. Okay. Now, in the first year, I will then come here. In the first year, this is year 1. We are told that in the first year, the cash flow is 100,000 at the probability of 0.25. In year one, cash flow is 100,000 at the probability of 0.25. Also, in the year one, we have a cash flow of 200,000 at the probability of 0.5. Cash flow of 200,000 at the probability of 0.50. Okay, then still in year one, cash flow of 300,000 at the probability of 0.25. 300,000 probability of 0.25. So with this, we have represented year one cash flow on a tree diagram. So after year one, you are supposed to close the event in year one, the scenario of that year one, you close it with the event node. So I will then come here again. I will close each of them. Okay. All right. So that's that for we are done with year one cash flow, with year one scenario. We then move to year two. So in year two, we are told that if cash flow in year one is 100,000, there is a probability of 0.25 that cash flow in year two will be nil. So let's interpret that. If cash flow in year one is 100,000, here is 100,000, okay? If cash flow in year one is 100,000, there is a probability of 0.25 that cash flow in year two will be nil. Therefore, I have to push this one up. All right. So if cash flow in year one is 100,000, there's a probability of 0.25 that cash flow in year two will be nil. Nil means zero, or you can just put nil there. So this is year two. All right. Again, if cash flow in year one is 100,000, there's a probability of 0.50 that cash flow in year two will be 100,000. So probability of 0.5 that cash flow in year two will be 100,000. Let me push that one a little bit down. Okay. Also, if cash flow in year one is 100,000, there's a probability of 0.25 that cash flow in year two will be 200,000 naira. All right. Cash flow 100,000, probability of 0.25 that cash flow in year two will be 100,000. 300 or 200? Let me see. 200,000. So here will be 200. So with this, I've also represented year two under the first scenario. Therefore, all I need to do is to also close the nodes. I need to close the nodes. So I will close the scenario of year two with a node. See now, the thing is almost joined to the the second one is almost joined to the first one. So anyway, let's move on. Now I'm done with that scenario. Move to the next one. If cash flow in year one is 200,000, that's a probability of 0.25 that cash flow in year two will be 100,000. So if cash flow in year two is, this year is 200,000, right? So that's a probability of 0.25. So in this case, I need to adjust this one. Let me push it down a little bit. Okay. You can see it's getting close to that one on the top. So that's the nature of decision tree. So probability of 0.25 that cash flow in year 2 will be 100,000. Is it 100 or 200? Let me confirm again. Yes, 100,000. So here is 100,000 naira. Again, I will close the node. That's too small. Okay. Let me adjust this. See the way I'm struggling? That's the nature of decision tree. You have to ensure that the lines touch the node. All right. This one too. All right. So next, if cash flow in year 1 is 200,000, there's a probability of 0.5 that cash flow in year 2 will be 200,000. Probability of 0.5 cash flow in year 2 will be 200,000. Then you complete with a node. Then if cash flow in year 1 is 200,000, that's a probability of 0.25. This one has joined. Okay, probability of 0.25. That cash flow in year 2 will be 300,000. 300,000. So here will be, let me write this. That's too long. So 300,000. Again, we close the node. All right, so that's that. Then these other ones, let me push it down to allow me so that I can have sufficient space. All right. Okay. Again, if cash flow in year 1 is 300,000, there is a probability of 0.25 that cash flow in year 2 will be 200,000. All right. This is 0.2, 300,000. This one, let it come like this. Okay. 0.25. Cash flow is it 300,000? Let me check. 200,000. Here will be 200,000. Let's push this one a little bit up. Okay, then you construct the chance node. All right. Then again, if cash flow in year 1 is 300,000, there is a probability of 0.5 that cash flow in year 2 will be 300,000. So let's put it there. 0.5, 300,000. We complete that diagram with chance node. Let me redraw it. And the last one, okay, if cash flow in year one is 300,000 naira, that is a probability of 0.25. That cash flow in year two will be 350,000 naira. I can push this one down. Here is 0.25. That cash flow in year two will be 350,000. Okay, then you close. That's it. That's it. So we have represented year one and year two cash flows in this diagram. Therefore, the next thing we want to do, and we have inserted, we have assigned probability and then monetary value to each of them. So the next thing we need to do is to label each node. So let's label the node. Again, when you want to label your node, you can do it alphabetically or numerically, whichever way you want to do it. It's still the same thing. Just know what you are doing. That's the bottom line. Let me redraw this decision node. Make it bigger a little bit. Okay. All right. So let's label the node. If you like, you can start labeling it from the left to the right or from the right to the left, whichever way you want to do it. Just know what you are doing. So let's start from the right. So call this the first one A, B, C, D, E, F, G, H, I, J, K, L, M, then N. Okay, so the next thing we are going to do is to compute NPV for each node. That's where you have major work, because in this question, we have given cost of capital. In that case, that means you need to discount the cash flow. That means you are going to calculate NPV for each node. So let's see how we are going to do it. Starting from node A. So I will then come here, node A. Let's say calculating NPV. So starting from node A, under node A, the same way you normally compute your NPV, create a column for year, cash flow, discount factor at 10%. Then we have present value, year 0, year 1, then year 2. You have to be as fast as possible on the day of your exam if you have this kind of a question, okay? Otherwise, it will waste your time. Now, in year 0, the cash flow is 300,000 naira. In year 1, from my diagram for this node A, I will trace this node A. I will trace it to year 1. The cash flow in year 1 is 100,000. The cash flow in year 2 is nil for node A. So node A, year 1 is 0. Year 2 cash flow is 100,000. Sorry, year 1 is 100,000. Year 2 is nil. So here is 100,000. Here is 0. Multiply by 1. Here is 0.909, 0.826. So I will then calculate my NPV. 300,000 multiplied by 1 will give me 300,000 initial outlay. All right. Then 100,000 multiplied by 0.909 will give me 9,900. This one is dash. Therefore, from my calculator, 300,000, 9,900 minus 300,000. That's minus 209,100. NPV is 209,100 negative. I can manage the second one for node B. For node B, do the same thing. Create a column for year, cash flow, discount factor, then present value. Year 0, year 1, year 2, 300,000. Also, for node B, here is node B. We are done with node A. For node B, year 1 cash flow is 100,000. Year 2 cash flow is also 100,000. 100,000. 100,000. Here is 1.909, 0.826. Here is 300,000. Here is 9,900. Here is 8,600. Then my NPV will then be equal to 82,600, 8,600 plus 9,900 equal minus 300,000. That's 126,500. 126,500 negative. I will move to node C. Let's use here node C. Create a column for year, cash flow, discount factor, present value. Year 0, 1, then 2. Initial outlay is 300,000 naira. For node C, let's go back to our graph. For node C, year 1 cash flow is 100,000. Year 2 cash flow is 200,000. Here is 100,000, 200,000. Discount factor for year 1 at 10%. Year 0 at 10% is 1. Okay? Here is 0.909826. 300,000. 9,900. Then 200,000. 200,000 multiplied by 0.826 equal 165,200. Then we get the NPV. So 165,200 plus 9,900 equal, then minus 300,000. That's 43,900. NPV is 43,900 negative. Note D. Year, cash flow, discount factor at 10, then present value. Year 0, 1, 2. 300,000 negative. Then year 1 cash flow for node D. Here is node D. Trace node D to year 1. Year 1 cash flow is 200,000. Year 2 cash flow is 100,000. 200,000. 100,000. Multiply by 1.909, 0.826. Here is 82,600. Here is 300,000 negative. Then 200,000. 200,000 multiplied by 0.909. Sorry, 0.909. That's 181,800. Here is 181,800. So I will then calculate my NPV for node D. 181,800 plus 82,600 equal, then minus 300,000. That's 35,600 negative. Okay, I'll move to node E. This is the most tedious part of the question, calculating NPV, because the more the nodes, the more the NPV you are going to compute. Even though it's straightforward, but it will take time. And that's why I usually advise students not to make this kind of a question your first attempt. It will waste your time. So for node E, year one cash flow, year cash flow, discount factor at 10, present value 300,000 initial outlay. Then in year one, node D, year one cash flow. Here is node D. Trace it to year one. I think we have done for D. E, yeah. So for node E, trace it to year one is 200,000. Year two is 200,000 cash flow. 200,000. 200,000 multiplied by 1,909,826. 300,000 negative. 200,000 multiplied by 200 will give us, yes, 181,800. Here is 181,800. 200,000 multiplied by 0.826. That's 165,200. Then we get the NPV. All right. So 181,800 plus 165,200 equal, then minus 300,000, 47,000. NPV is positive 47,000 for node E. I will calculate for node F. Cash flow. Discount factor at 10%. Present value. Year 0, 1, 2. 300,000 negative. For node F, on the tree diagram, node F, you trace it to year one, it's still 200,000. Year two is 300,000. 200 for year one, 300 for year two. Here is 1.909,826. 300,000 negative. 181, 200, sorry, 800. Then 300,000 multiplied by 0.826. That's 247,800. So I will get the NPV. 247,800 plus 181,800 equal, then minus 300,000. 129,600 NPV. So we are done with node F. The next one is node after F, node G. For node G, year one is 300,000, year two is 200,000. Year 0, 1, 2, 300,000. Node G, year one is 300,000. Year two is on 200,000, 300, 200, 300, then 200. One, joy email. You are drawing on my screen. Stop it. 0.909, 826, 300,000. So 300,000 multiplied by 0.909. Sorry, 0.909. That's 272,700. Okay. Then 200,000 multiplied by 0.826. That's 165, 200. NPV for node G would then be equal to 272,700 plus 165, 200 equal minus 300,000 equal 137,900. Okay, so that's that. Then for node after node G, we have node H. All right, year 0, 1, 2, 300,000. For node H, go back to the diagram. For node H, year one cash flow is 300,000 naira. Year two cash flow is 300,000. 300,000 each. Multiply by 1.909, 826, 300,000, 272, 700. Then 300,000 multiplied by 0.826 will give us 247,800. Okay, then the NPV will then be equal to 247,800 plus 272,700 equal minus 300,000, 220,500. That's the NPV for node H. After node H, we have node I. Okay, node I. Year one cash flow from the diagram is 300,000. Year two cash flow is 350,000. 300,000. 300,000 for year one. 350,000 for year two. 909,826. 300,000 negative. Here is 27 something. 272,700. Okay. Then 350,000 multiplied by 0.826. 289,100. So we get the NPV. This is very cumbersome. So plus 272,700 equal minus 300,000. That's 261,800 naira. Okay, so we have computed NPV for node I. So we are left with 5 nodes. Node J, K, L, M, and then N. The next one is node J. Okay. For node J, when you look at node J, let's go back to the diagram. When you look at this node J, you will see that node J is coming from node A, B, and C. Node J is coming from node A, B, C, A, B, and C. Therefore, you are supposed to combine the NPV of node A, B, and C. For node J, combine the NPV. Let me write it down so that I don't manage space. Node J. So combine the NPVs of nodes A, B, and C. So in this case, I would then say nodes A, B, C. I will do workings or just say NPVs, probability, then the expected value. For node A, we computed NPV of node A to be 209,100 negative. 209,100 negative. What's NPV of node B? NPV of node B
126, 500
500 negative.
126, 500 negative. NPV of node C.
43,900 negative.
43,900 negative. Now, remember, we are doing for node J. I will then go back to the diagram. For node J, for this node J coming from A, the probability from A is 0.25. Probability from B is 0.5. Probability from C is 0.25. Therefore, I will then come here. Probability is 0.25, 0.5, then 0.25. I will multiply to get the expected value. So 209, 100 multiplied by 0.25 equal 52275. 52275 negative. Again, 126, 500 multiplied by 0.5, 63250. 63250 negative. Then also for node C, node C NPV 43,900 negative multiplied by 0.25 equal 10,975. 10,975. I will then add everything together. So this will then give us plus 63,250 plus 52275. Now we're done. That's 126, 500 negative. So that's the expected value for node J. I will then move to the next node after node J. Node J, the next one is a node K. Let's go back to the diagram. For node K is coming from node DEF. Node K is coming from node DEF. Therefore, you combine the NPVs of node DEF. Combine the NPVs of nodes DEF. Okay. So, nodes NPV probability, then expected value. Node D, E, F. All right. So what's the NPV of node D?
35,600 naira negative.
45,600.
35.
35.
35. Oh, okay, 35 negative. Node E.
47,000 positive.
47 positive. Node F.
129,600 positive.
129,600. Okay, then I will go back to the diagram. What's the probability of DEF to K? Probability of D is 0.25. Probability of E is 0.5. Probability of F is 0.25. Okay. Here is 0.25, 0.50, 0.25. So let's multiply to get the expected value. 35 600 multiplied by 0.25 negative. That's 8,900 negative. Note E, expected value, 47,000 multiplied by 0.5, 23,500. Let me write it. Then for note F, 129,600 multiplied by 0.25.
32,400.
32,400. This is very strenuous. All right. Then I will get the expected value. Okay. 32,400 plus 23,500 equal, then minus 89.
47,000.
47,000. After note K, we have note L. Note L is coming from note GHI. Note L is coming from note GHI. Therefore, we combine the NPVs of nodes G, H, and then I. So, node NPV probability, then expected value. Node G, H, I. Give me the NPV of node J.
137,900. 137,900.
137,900. Node H.
220,500.
220,500.
Sir,
Node I.
261,800.
261,800. Okay.
Size GHI, not JHI. The
Node
notes that we are
JH.
picking from is GHI.
G as in
G.
God.
G in God.
Let me see. Oh, sorry. Error of mind. Yeah. I was pronouncing G. Then I was writing down J. Yeah, it's GHI. Thank you. So this one's supposed to be G also. All right. So probability is 0.25, 0.50, then 0.25. So let's multiply to get the expected value.
34,475.
34,
475.
435.
475. 75.
475. Okay.
110,
250.
Okay.
65,
65,
450.
450.
65, 450. Add it up.
210,
210,
175.
175.
210,
175.
175. We have two more to go. We are moving to node M. From the diagram, when you look at node M is coming from node JKL. Therefore, you combine the NPV of node JKL. Node M. combine the NPV of nodes J, K, and L. So nodes J, K, L. NPV, probability, then expected value. For node J, what's the NPV of node J?
126,500 negative.
126,500 negative. Node K,
47,000 positive.
47,000 positive. Then node L,
210,
210,
175 positive.
175. Probability of 0.25. Because when you look at M also have probability coming from JKL. So from node J is 0.25, from K 0.5, from L 0.25. So you need to include probability. Okay. 0.50, 0.25. So let's get the expected value. What do you have? Yes.
31,625 for J.
31,
625
62, negative.
negative, yes. 23,500. Okay, 52,544 for L.
52,544. This one is 31. So final answer,
44,419
44,419.
positive.
Then positive. So the last one is node M. Node N. Node N is coming from node M. Therefore, since node N is coming from, let me go back to the diagram. From the diagram, node N is coming from node M. Therefore, whatever you have as node M will become node N. Therefore, node N, which is equal to 44,419. So if I like, I can come here to say where you have node N, I can say 44,419. That's my final answer. I will then say the expected NPV. Okay, the expected NPV. The expected net present value using decision tree is 44,409 naira. That's it. That's it. Finally, the second part of the question, number B, examiner is asking you, what is the probability that the NPV will be negative? Okay, number B, probability that NPV will be negative. What's wrong with you? So examiner is asking you, what is the probability that the NPV will be negative? When we calculated the NPVs, you will notice that for node A, we got a negative NPV of 209,100. Node B, we got a negative NPV of 126,500. Note C, we got a negative NPV of 43,900. Note D, we got a negative NPV of 35,600. Those are the four nodes that produce negative NPV originally. Therefore, examiner is now asking you, what is the probability that the NPV will be negative? So since node A, B, C, and D produce a negative NPV, then what am I supposed to do? All I need to do for year one, node A, I will multiply the probability of year one with the probability of year two. I'll keep it down. For node B, probability of 0.25 multiplied by probability of 0.5. I'll keep it down. That's how I'm going to do for node A, B, C, and D. Yes, Temitope, talk to me.
So what about node J? We also have a negative figure there.
No, node J is coming from node A, B, C. You see that for node J that are talking about, where is node J? So all those ones, they are coming from node A, B, and C. You know, we have computed originally is node A, B, C, and D. After node A, B, C, and D, node E, we got positive. Thereafter, they are all positive. So all this one for node J is coming from somewhere. So we are talking about originally the node that is not coming from anywhere. All right. So of
Okay,
course,
sir.
this one is also 126,500, but it's not part of, because this one is coming from node A, B, C, A, B, and C. All right, it's not part of it. So I would then come here. I will say the probability that the NPV will be negative is the NP is the nodes with the negative NPV. The nodes with the negative NPV. This is calculated as follows. So I will then come here, create a column for nodes, working for probability, then probability. So we have identified from the question that those nodes that originally produce negative NPV, they are the one that will produce a negative, they will produce a negative NPV. So we have node A, B, C, and D. So to now get the probability that the NPV will be negative, so we are going to pick probability of year one for each node. You multiply with the probability of year two. So for year one, node A, probability is 0.25 multiplied by the probability of year two for node A, which is the same thing as 0.25. Let me go back so that we're picking the right number. So for node A, here is node A. Year one probability is 0.25. Year two probability is 0.25. So you multiply the two together. For node B, year one probability is 0.25. Year two probability is 0.5. 0.25. Year two is 0.5. Node C, year one probability is 0.25. Year two probability is 0.25. Node D, year one probability is 0.5. Year two probability is 0.25. Let me confirm that from the diagram. Node D, yes, node D, year one probability is 0.25. Year two probability is year one probability is 0.5. Year two probability is 0.25. So that's it. We are correct. So multiply together. So 0.25 multiplied by 0.25.
0.0625.
0.0625. 0.25 multiplied by 0.5.
0.125.
125. 0.0625. 0.125. So we then add up everything together. What do we have?
0.1875.
0.187. Okay, Lila.
0.375.
0.375. The answer is 0.375. So 0.375 is the same thing as 37.5%. Therefore, the probability that the NPV will be negative, the probability that the NPV will be negative is 37.5%. That's the end of the question. Okay? It's as simple as that. All right. So let me know if you have any question on this. Let me know if I can, that one that does not involve cost of capital. Maybe we can treat it, or if I solve it under PM, I will share with you. But we still have a long way to go. So far, we have working capital, specific investment decision, which is hire purchase versus lease. That's true. We have projects, we have portfolio theory. We have capital asset pricing model. That's 4. All right. We have business valuation, 5. We have about 5 outstanding. So, and we have just practically maybe 5 periods to go. How do we want to achieve it? It will be very difficult. So we have to maximize the little time that we have. All right. So what I will do is that, let me stop sharing this and move to the class notes. So this illustration number 7 in the material on the same page, this illustration number 7, I will solve it under performance management, then I will share with you, because the mistake I made was that I was supposed to match all of you that are doing PM with those that are doing FM under risk and uncertainty. Is the same thing. All right, it's the same thing, except that for performance management, we are going to do decision making under uncertainty, where you have maximus, maximi, minimax, Laplace, and all of that. But you don't have that one under financial management. Okay, we don't have it under financial management. So I will solve this illustration number 7 under PM, then I will share with you so that you have understanding of how I treated it. Okay, now let's go back. Let's go back to certainty equivalent method and then risk adjusted method. Let's go back to certainty equivalent method and risk adjusted. Like I mentioned to you earlier, especially at this level, examiner may test it. So, and I don't want a situation whereby you then say, oh, we are not taught. That's why. All right. So try as much as possible, because again, this thing is examinable. Examiner can ask you to list method of hedging risk or method of mitigating risk and uncertainty. So if you're able to list like 7 out of these 14, you are good to go. All right. If you list 10, perfect. All right. So just try as much as possible to master all of them if possible. Okay. All right. So let's talk about You have to read everything, including the shorter payback period. So just go through them. So it's nothing difficult. But let me just do some kind of illustrative analysis on the risk-adjusted method as well as a certainty equivalent method. Now, the bottom line is that when it comes to risk-adjusted method, it's a method of mitigating risk and uncertainty, whereby a risk premium is added to the company's cost of capital to evaluate a project. Say, for example, you want to evaluate a project, okay, and you are given cost of capital of 20%. You are given cost of capital of 20%. You are also given risk premium, okay? You are given a risk premium of say 5%. So you know that anytime you want to compute NPV, you normally use the company cost of capital. So instead of you to evaluate the cash flow using the cost of capital of 20%, you are supposed to add the cost of capital of 20%. You add it with the risk premium of 5%, so that you are going to discount the future cash flows using 25%. So with this, you have incorporated incorporated the element of risk in your cash flow variability. So that is the only difference. This is this. So when you are now calculating your NPV, you are going to use 25% to discount the cash flow. That's what you need to do under the risk adjusted method or risk premium method. That's the summary. That's the summary. Then let me look for, there's no example in this material. Let me open to Golden Book to just show you. Let me stop sharing this. Quickly, let me go to Golden Book and just share with you so that we see the illustrative example that we have there. Just 1 minute, please. Okay, coming up. This is risk and uncertainty. Let me see. Risk adjusted. Hold on. Risk adjusted methods. No. Let me just search. Let me share my screen with you first. Okay, let me search for it. 12. What's wrong with you? Risk premium or risk adjusted method. Okay, so that's it. This is it here. So for example, let's have this illustration as an example to demonstrate this is how the question will be tested. So ABC Limited has decided to commit 800,000 naira into a project for a period of 4 years. The expected annual cash flows are given below. Year 1, 300,000. Year 2, 250,000. Year 3, 400,000. Year 4, 200,000. The company's cost of capital is 10%, while a risk premium of 5% has been provided to account for the variability in the cash flows. Required, advise the company if the project should be accepted using risk-adjusted method. So examiner wants you to compute NPV using risk premium method. So in this case, what am I supposed to do? It's very simple. The same way you normally compute your NPV is the same way you are going to do this. However, because your examiner wants you to use risk-adjusted method, in that case, you are supposed to add the company cost of capital of 10% and the risk premium of 5%, you add it together such that you are going to discount these future cash flows. All these future cash flow, you discount it at the cost of capital of 15%. That's all you need to do. Okay, so let's see the solution. All right. To calculate the NPV, the project cash inflows will be discounted at 50. I've already explained these ones. All right. Therefore, I will list the cash flows as given to us. These are the 300, 250, 400, and 200. Now, we are going to discount the future cash flows at the cost of capital plus the risk premium of 5%. That's what gave us this 15%. So 15% discount factor for year 1 is 0.870, year 2 0.756, year 3 0.658, year 4 is 0.572. Then you multiply to get the present value. These are the present value for each year. Year 1 present value is 261,000. Year 2 is 189,000. Year 3 is 263,200. Then year 4 present value is 114,400,000. When you add up the positive present value, you net off 800,000. That will give us NPV of 27,600. So since our NPV is positive, it means that the project is financially viable and should be accepted, because examiner is asking you to advise if the project should be accepted. So if you don't advise, you cannot earn your full mark. Okay, so I would then say the project is financially viable considering the positive NPV of 27,600. Therefore, the project should be accepted. That's all. So this is the simple thing you need to do under the risk adjusted method or risk premium method. Just add the risk premium with the company cost of capital. You then use the addition of the two to discount the future cash flow to get your NPV. That's all you need to do under the risk adjusted method. Okay, I believe that is clear. Let me know if you have any concern on that so that I can move to certainty equivalent method. All right. Yes, under the certainty equivalent, moving to certainty equivalent method. Again, just like the risk adjusted method, the certainty equivalent method is used to hedge the risk inherent in a project. However, when computing NPV, the cash flows and the certainty equivalent factor as well as the discount factor should be multiplied together to get the present value. This is what I'm trying to say. The certainty equivalent method relies heavily on the use of equivalent factor to appraise a project, okay, to appraise a project or to incorporate risk when evaluating a project. So when you want to calculate NPV using certainty equivalent method, the most important thing to do is to multiply the cash flows with the equivalent factor and then the discount factor to get the present value for the purpose of calculating NPV. That's all you need to do. That's the summary. That's the summary of what you need to do. Okay. Now, when you now want to, once your NPV is positive, it means that the project should be accepted. All right. If NPV is positive, it means that the project is accepted. The only thing here under certainty equivalent method is that you are using equivalent factor to adjust for the risk. That's all. That's all you need to do. So let's have example under this. Awilo Limited has the objective of maximizing shareholders' value. The company is considering investing 1 million naira. It's not 1 million naira, it should be 800,000. Okay, that's a typo somewhere. So it's 800,000. All right, that value is 800,000. In a project for a period of 5 years. The project is expected to generate the following annual cash inflows with their respective certainty equivalent factor. Okay, so you have been given the cash inflow and the certainty equivalent factor. This equivalent factor ranges from 0 to 1. All right, equivalent factors usually range from 0 to 1. So the cost of capital is 10%. You are required to advise Awilo Limited whether the project should be undertaken. This is very straightforward. All you need to do to get your present value, for each year, what are you supposed to do? You just multiply cash flow with the equivalent factor, okay? And then the discount factor for each year. That's all. That will give you present value for each year. Then you now add up the present value, you net off the negative present value, you have your NPV. Provided the NPV is positive, the project is financially viable. But if the NPV is negative, the project should not be undertaken. That's all you need to do under the certainty equivalent method. So quickly, let's solve this question. You can see it from the solution in the table. Okay, what did I say here? To calculate the NPV, the cash flows generated by the project will be multiplied with the discount factor and equivalent factor to get the annual present value. Okay, so see the same thing I've already explained. Like I said, this one's supposed to be 800,000. It's a typo. This one is supposed to be 800,000 because the calculation was based on 800,000. All right. Now, the cash flow given in year 1 is 200,000. Year 2 is 400,000. Year 3 is 500,000. Year 4, 700,000. Then year 5 is 200,000. So the discount factor at 10% for year 1 is 0.909, year 2, 0.826, year 3, 0.751, year 4, 0.683, then year 5 is 0.621. Equivalent factors given to us is 0.894, 0.811, 0.746, 0.701, then 0.690 for year 5. So to now get the present value, we are supposed to multiply cash flow with the discount factor and then equivalent factor. Okay, so when you do that for year 1, 200,000 multiplied by 0.909 multiplied by 0.894, we are going to have 162,529. Okay, 400,000 multiplied by 0.826 multiplied by 0.811, you have present value of 267,954, right? For year 3 cash flow, 500,000 multiplied by 0.751 multiplied by 0.746, it will give us a present value of 280,123. Year 4, 700,000 multiplied by 0.683 multiplied by 0.701 multiplied by, so that will give us 335,148. Then the last one, 200,000 multiplied by 0.621 multiplied by 0.690 will give us the present value of 85,698. When you add up 162,529 plus 267,954 plus 280,123 plus 335,145 plus 85,698. You are going to minus everything minus 800,000, which will give us a difference of 131,452. 131,452. Okay, so that is, since our NPV is positive, we then say the project is financially viable and should be accepted. So this is what you need to do under the certainty equivalent method. This is how to calculate certainty equivalent method. Ordinarily, I would have ignored this because it's very straightforward. But again, it now occurred to me that this is financial management. At this level, it is possible examiner can test it. But if this one were to be at professional level, it can't be. This is a no-go area. Yes, Mr. Victor, talk to me.
Thank you, sir. Sir, to correct you, sir, the Awilo Limited is the 1 million naira is the amount.
The
Cost is
initial
the
outlay
initial
is
outlay.
800,000.
No, looking at the solution, the NPV of 131,452 is based
Yeah.
on the 1 million naira initial outlay. It's the first
No, it's
example. ABC Limited
part.
at 800,000.
Oh, okay.
The
Let me
first
see.
example under risk adjusted discount method, the initial outlay
No,
is
no, 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 no.
800,000.
No, no. See, when you look, let's do it together. Let's do it together. I did not even notice. One of you that bought the book was the one that called my attention to it. So that was why I was able to discover the typo there. Now let's do it together. Let's do it together. 162,000, 162,000. All right.
529. Yes.
529
Yes.
plus
267.
267
954
954 plus
plus 280
280
123
123
plus
plus
335
335
148
148
plus 85 698.
plus 85 698
Yes.
equal, then minus, oh, okay, no, that means I've updated it. I've updated it, that's why. Thank you. So when the person made it initially, it wasn't like that. So when the person commented on, I think I went ahead to update it. Yeah. So now, so leave it as 1 million naira. It's okay. All
All
right.
right.
It's okay. Yeah.
Thank you, sir.
Yeah. Welcome. Thanks for that observation. Yeah.
You're welcome, sir.
Okay then. Let me, including this one too. Leave it as 1 million. All right. So this is how to calculate certainty equivalent method. All right. Certainty NPV using certainty equivalent method. So that will be that for risk and uncertainty. Let's use the remaining minutes that we have to talk about let's talk about specific investment decision. Let's talk about specific investment decision. Or let me see. If I do specific investment. No, let's talk about working capital. Because if I do specific investment decision now, I need about 2 hours. And the hours that we have is not sufficient to cover it. I don't want to do small now and do another small one next time. So let's just continue. Anyway, let me stop sharing this. Okay.